Welcome back to Investing Talk Podcast.
Today we're looking at Reddit.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us get these insights out to more people.
And frankly, we need to get this one out there because we are looking at perhaps the most confusing, paradoxical situation in the market right now.
Oh, absolutely. I've been staring at these numbers all morning, and my head is spinning. Usually, stock analysis is pretty binary, right?
Mm-hmm.
Company does good, stock goes up.
Yeah.
Company does bad, stock goes down. Simple.
Right. Fundamentals usually drive the price action. It's the law of gravity in finance.
But with Reddit's Q4 2025 performance, gravity seemed to be broken. On one side, you have a company that is absolutely crushing it. I mean, blowout numbers.
Sort of blowout.
But on the other side, looking at the chart, it looks like a crime scene.
It really does. We have a complete decoupling of business performance and market sentiment. And that is where the opportunity usually hides.
So let's set the stage. We are talking about a stock that just suffered a 46% decline in a single month. That is brutal.
Just brutal.
That is delete your trading app levels of pain.
It is the definition of a falling knife.
But, and here is the hook, at the exact same time, they just posted revenue surging 70% year over year to $726 million.
70%. 7-0. Just let that sink in for a platform this size.
It's massive. So our mission today is to figure out who is wrong. Is the market seeing some kind of fatal flaw that these headline numbers are hiding?
Right.
Is this company actually driving off a cliff? Or is this a massive market inefficiency where fear has just completely detached from reality?
That is the battle. Execution versus sentiment. And to figure out who is right, we have to strip away the noise and look at the engine. Because that 70% revenue growth number, it isn't just some lucky spike, it looks structural.
Okay, let's unpack structural. Because for a decade, the knock on Reddit was that it was the Wild West of the internet. You had millions of users, sure, but they were anonymous, they hated ads, and you couldn't target them.
A total monetization nightmare.
Exactly. How did they turn that into $726 million in a single quarter?
They finally built the plumbing. If you look at the breakdown of that revenue, advertising revenue specifically jumped 75% to $690 million.
Wow.
That doesn't happen just because more people logged in. It happens because the ad tech got smarter. They rolled out two specific tools that really changed the game: dynamic product ads and the Reddit Pixel.
Okay, hold on. Let's pause on those because they sound like standard marketing buzzwords.
Yeah.
We hear about pixels and dynamic ads from Meta and Google all the time.
Yeah.
Why is this a breakthrough for Reddit?
Well, think about the old Reddit ad model. You'd put a generic banner up in a subreddit and just, hope for the best.
Like throwing flyers out of a moving car.
Exactly. Dynamic product ads change the physics of that. If you're browsing a subreddit about hiking gear, Reddit can now serve you an ad for the specific hiking boots you were looking at on a different site yesterday.
So they are finally closing the loop. It's retargeting.
It's retargeting, it makes the ads relevant, and the Reddit Pixel is the other half of that equation. It's a piece of code that advertisers put on their own websites. It allows them to track exactly what a Reddit user does after they click the ad. Did they buy the boots? Did they put them in the cart? Before this, advertisers were flying blind. Now they have attribution.
Which basically brings them up to parity with where Facebook was, 5 or 6 years ago?
Roughly, yeah. But here is why that matters for the stock. Adoption. Advertisers are flocking to it because it finally works. They aren't just testing the waters anymore. They are pouring budget in. And the leverage on the bottom line is incredible. They didn't just beat revenue estimates, they crushed earnings. For Q4, EPS earnings per share came in at $1.24. The street was only expecting 94 cents.
That is a 32% beat. That is not a rounding error?
No. And if you look back at Q3, they beat by 54%. This is a pattern. It's what we call sandbagging, consistently under-promising and over-delivering.
Right.
When you have a software company that starts turning the profit corner, the margins expand very, very quickly. It's called operating leverage. Your costs stay relatively fixed.
Sure, you don't need to hire 1,000 new engineers to serve 1 million new ads.
Exactly. So that extra revenue flows straight to the bottom line.
But operating leverage only works if the user base keeps growing. We've seen platforms like formerly Twitter struggle with stagnation. You can have the best ad tech in the world, but if nobody is scrolling, you have no inventory to sell. How is the user health?
The pulse is stronger than ever. Daily active users, or DAUs, hit 121.4 million. That's up 19% year over year.
Okay, 19% is solid.
It is. But I actually think the weekly active user count is the more impressive number here, 471 million.
471 million people a week. That is
Not rare.
that is effectively larger than the population of the United States and Mexico combined. It's staggeringly large population.
It is massive, and it's growing at 24%. But the metric that really matters, the one that proves the dynamic product ads are actually working, is the ARPU, average revenue per user.
And this is usually the hardest metric to move, right? Adding users is easy if you have a viral hit. Squeezing more money out of each one is the hard part.
Precisely. And in Q4 2025, ARPU rose 42% to $5.98.
A 42% jump in monetization efficiency? That seems incredibly high for a mature platform.
It is high. It just validates the thesis that Reddit's audience was severely undermonetized for years. They're essentially catching up to their potential. If you think about it, Reddit users are high intent. If you are in a subreddit about home theater, you are likely looking to buy speakers. That is valuable data that Reddit is finally capturing.
That makes sense. It's context. On Instagram, I'm looking at photos of my friend's brunch. On Reddit, I'm actively researching which 4K TV to buy. The commercial intent is baked into the usage.
Exactly. That's the aha moment for advertisers.
Okay, so the rearview mirror looks great. They fix the ads, the users are growing, and they're making money. But the stock market is a forward-looking machine. The reason a stock drops 46% usually isn't about what you did, it's about what people think you're about to do.
Right.
Was the guidance terrible? Did they warn that the party is over?
See, that's the weird part. The guidance wasn't a disaster at all. For Q1 2026, they are guiding for roughly $600 million in revenue. And for the full fiscal year of 2026, they're projecting $3.14 billion with an EPS of nearly $4.
So they are projecting growth to continue. I mean, $3.14 billion is a serious number.
Yes, and they are backing it up with cash. Post-earnings, the board authorized a $1 billion share repurchase program.
Let's stop there. I want to challenge this. $1 billion in buybacks for a growth company. To me, that can be interpreted two ways.
Okay.
The bullish take is confidence. The bearish take is lack of ideas. If they're growing so fast, shouldn't they be pouring that billion into R&D or buying a smaller AI competitor or expanding into video? Does a buyback signal that they've run out of high-growth places to deploy capital?
That is a valid skepticism.
Yep.
Usually, you want growth companies to reinvest, not return capital. However, you have to look at the context of the stock price. When your market cap gets slashed by nearly half in a month, your own stock becomes the best investment on the board.
So it's opportunistic.
Exactly. With a 24% profit margin and a return on equity around 21%, they are generating cash. By buying back shares at these depressed levels, they're essentially saying to the market, you are wrong about our valuation and we're going to exploit your mistake. It's less about running out of ideas and more about financial engineering to support the floor price.
It's a vote of confidence backed by a checkbook. It's basically management saying, we know what we're worth, and this isn't it.
It is. And that confidence stems from their moat. We talk about network effects a lot, but Reddit's is unique. It's not based on your social graph like who you went to high school with, which is what Facebook is. It's based on interest graphs.
Right. You don't go to Reddit to see pictures of your cousin's baby. You go to argue about sports or find a fix for your dishwasher.
And that creates high switching costs. If you are a deep participant in a niche community, let's say the mechanical keyboards subreddit, you can't just pick that community up and move it to TikTok or Instagram.
No, the format doesn't support it.
Right. That creates a defensive trench around their user base that is very hard for competitors to cross.
That authentic content angle is interesting, especially now. There is this concept of the dead internet theory, that half the internet is just bots talking to bots. Reddit feels like one of the last bastions of messy, real human interaction.
Which is becoming a premium asset for training AI models, by the way. But that's a whole other revenue stream we can touch on later.
True. But let's pivot to the charts. Because while the fundamental story sounds great, we have a moat, we have growth, we have cash, the market obviously hates something here. You don't get a 46% monthly decline by accident.
No, you don't.
What is the technical damage looking like?
It's ugly. There is no sugarcoating it. The momentum broke hard. But we are seeing the first signs of a pulse. Recently, there was a 6.5% single-day surge, up to around $139.
Is that a real reversal or just a dead cat bounce? You know the saying, even a dead cat will bounce if you drop it from high enough.
It looks more constructive than a dead cat. We are seeing what technical analysts call basing.
Explain that for the listeners who aren't staring at candles all day.
So when a stock crashes, it feels like a free fall. Sellers are panicking, dumping shares at any price. Basing is when that selling pressure finally exhausts itself. The stock stops making new lows, it starts to trade sideways, it takes a breath, it indicates that the weak hands are out, and long-term accumulators are stepping in. We are seeing that floor form near the recent lows.
And this is happening independently of the broader market.
That's the key. For a while, Reddit was just drifting with the tech sector. Now we are seeing independent volatility. The stock showed reversal patterns even when the Nasdaq was doing something else. That suggests the specific narrative for Reddit is starting to take over.
What about the big money, the institutions? Are they positioning for a rebound?
Well, we are seeing elevated volatility post-earnings, which usually implies high options flow. The institutions are reassessing. But the most bullish technical signal is actually fundamental. Revisions.
Analyst revisions.
Yes. Despite the price crash, analysts are quietly upgrading their earnings per share expectations. This is a classic divergence. The price is going down, but the profit expectations are going up.
That sounds like a coiled spring.
Yeah.
If the company is going to make more money than expected, but the stock is cheaper, the valuation multiple is getting crushed, eventually that has to snap back.
Exactly. Fundamentals act like gravity. Eventually, price has to align with earnings power.
So let's look at who is making those calls. Now, you mentioned revisions, but what are the big banks actually saying? Usually, when a stock drops 50%, the analysts scramble to downgrade it so they don't look stupid.
And we are seeing a bit of that. The current mood on Wall Street is hesitant. It's neutral.
Neutral feels like a cop-out.
It's safety. Look at Goldman Sachs. They cut their price target from $236 down to $206, but they kept the rating neutral. JP Morgan did the same thing, cut from $227 to $200 neutral.
So they were just chasing the price down. They aren't saying the business is broken. They're just acknowledging the stock is low.
Precisely. They are marking to market. But there is one outlier that is worth paying attention to, Oppenheimer.
The contrarian.
In this case, yes. They are maintaining an outperform rating, which is basically a buy.
Okay.
Now, they did lower their target from $300 to $250, but think about that spread. The stock is trading around $140. They think it's going to $250.
That is nearly a 100% upside from here. A bold call when everyone else is sitting on the fence.
It's very bold.
But here is the piece of the puzzle that bothers me. If Oppenheimer is right and the stock is trading at half its value, where are the insiders? You mentioned the corporate buyback, but are the CEO and the CFO buying shares with their own personal accounts?
That is the missing piece of the bull case. We checked the Form 4 filings. There is no cluster buying, no wave of executives picking up shares with their own money.
That's a red flag for me. If I'm the CEO and I know my company is about to print money and my stock is 50% off, I'm buying. Why aren't they?
It could be blackout periods or it could be personal diversification. But
Yeah.
You're right, it's not the ringing endorsement you want to see. However, the $1 billion corporate buyback acts as a strong proxy. The company is buying, even if the individuals aren't yet.
Fair enough. Before we get to the risks, are there any hidden cards, any tech that isn't fully priced in yet?
There is one speculative catalyst, the Max campaigns.
Sounds like a superhero movie. Or a protein shake.
It's their new AI-driven ad optimization tool. It's currently in beta. The idea is similar to Meta's Advantage Plus Cheese Suite. You give the AI your creative and your budget, and it figures out the best placement, timing, and targeting automatically.
So it lowers the barrier to entry for small advertisers. You don't need a marketing degree to run an ad. The AI does it for you.
Exactly. And if this works as well as it did for Facebook, it could drive ad pricing and efficiency significantly higher. It's a potential upside surprise that isn't fully baked into the current models.
So we have a potential AI catalyst sitting in the wings.
Yeah.
Okay, we built the bull case. Revenue is up. Tech is improving. The stock is cheap. Now we have to look at the dark side. Why did the market panic? It's time to look at the risks. Why did this drop 46%?
Right. It didn't happen for no reason.
Not at all.
No, it didn't. The bear case is a three-headed monster. Macro, regulation, and valuation. Let's start with macro. Advertising is cyclical. It is always the first line item a CFO cuts when they get nervous.
And with all the talk of tariffs and trade wars potentially slowing the global economy, ad budgets are fragile.
Correct. If we enter a recession or even just a slowdown, that 70% growth rate will evaporate. Reddit is 100% reliant on ad spend. They don't have a massive subscription business to fall back on, really. If the tap turns off, the growth story breaks. It's high beta. When the economy is good, it's great. When the economy is bad, it's terrible.
Exactly. And then there's the government. We've seen a massive shift in tone regarding social media regulation, especially for younger users.
This is a huge topic right now, specifically in Europe, right?
Yes. We are seeing aggressive moves, citing the Czech Republic example recently, pushing for bans on social media for users under a certain age.
If you ban the kids, you kill the future funnel.
That's the long-term risk. If regulations tighten, daily active user growth could stall because 16-year-olds can't legally log in. However, I will offer a counterpoint here.
Okay.
Reddit's ad focus is still heavily US-centric. They aren't as exposed to European regulation as TikTok or Meta. So while it's a headline risk, the immediate revenue impact might be muted.
That's fair. But you can't ignore the competition. Meta and Snap are always looming. Can't they just clone Reddit, Instagram communities or something?
They have tried. Remember Threads? It was supposed to kill Twitter. It didn't. It's very hard to manufacture culture. Reddit's culture is weird. It's chaotic. It's anonymous. Yeah.
That is very hard to replicate in a polished, brand-safe environment like Instagram. You can copy the code, but you can't copy the community.
That's a good point. Corporate sanitization usually kills community vibes. Finally, on the bear case valuation, even after the drop, is this stock actually cheap? Or was it just absurdly expensive before?
That is the big question. The skeptics argue that the 70% growth was a post-IPO pop, a one-time surge of curiosity that will fade. They think the stock was priced for perfection, and now it's just returning to reality.
But you mentioned ARPU earlier.
Exactly. When I look at that ARPU growth, the 42% increase in revenue per user, that suggests this isn't a fluke.
Yeah.
It suggests they are fundamentally fixing the business model. It's not just a sugar rush. It's a diet change.
All right. We've weighed the evidence. We have the exploding ad revenue, the skeptical market, the regulatory clouds, and the contrarian buy signals. We've looked at the growth against the risks. What is the final call? What is the verdict?
When I look at the whole picture, the disconnect between the business performance and the stock price, I'm giving Reddit a bullish score of 8/10.
An 8 out of 10. That is aggressive, given the volatility.
It is, but here is the thesis. You have a company growing at 70%. You have profitability expanding faster than revenue. You have a management team that is buying back stock. And you have a valuation that has been cut in half due to macro fears that haven't actually hit the balance sheet yet.
So the elevator pitch is the market overreacted.
The market is pricing Reddit like a dying social media app, but the data shows it's a burgeoning ad network. The opportunity here is that the 46% pullback offers a rare entry point into a company that is accelerating toward 56% growth in Q1 2026.
You mentioned Q1 2026. Is that the timeline?
Yes. This is not a day trade. This is a multi-year hold. I am specifically looking at the Q1 earnings, which should drop around April 30, 2026.
What do you want to see on that date?
I want to see that 56% growth target materialize. If they hit that, it proves the max campaigns and the ad tech are scaling. If they miss, then the bears were right about the macro slowdown. But right now, the risk-reward is heavily skewed to the upside. The key drivers, AI ads and strong network moats, are intact.
So, buy the fear, hold for the fundamentals.
Exactly. It's a long-term play on the modernization of the internet's discussion layer.
And if they can keep those 471 million people arguing about vintage watches and hiking boots while serving them highly targeted ads, the stock should take care of itself.
That's the bet.
Well, there you have it. A chaotic chart, but a very disciplined business underneath. As usual, before we go, subscribe, like, and comment to this video to support the channel. We'll catch you on the next one.